Yeah, my name's David Ironside. I have been at LaSalle now for 19 years. I've done quite a number of things. I've head of acquisition, I've been CIO, and what I do now is I run our pan-European open-ended fund, Encore Plus. And LaSalle is, I think, known to most of you, but we manage 62 billion euros of real estate on a global basis.
My name is Maureen, Mahr von Staszewski. I actually joined Swiss Life just before the summer, so I'm quite new to the group. Historically, I've been doing more value-add, opportunistic real estate across Europe, and I've joined Swiss Life to develop their European strategy across Europe.
My name is Carsten Loll. As many of you know me, I'm partner at Linklaters Real Estate Transactions and based in Frankfurt and Munich. I live in Munich and love Munich, so I'm happy, Richard, that that we can host together this event here, which I have attended a couple of times in London and Frankfurt, but first time here. So we should show some pride for our nice hometown.
Great. Claus, CEO of BNP Paribas Real Estate Investment Management here in Germany, in particular responsible for the investor side and fund management. BNP Real Estate Investment Management manages across Europe something like 29 billion euros of assets under management.
Excellent, thank you. Maybe let's start with you, David. Just in terms of when you look back over the last 12 months, but actually you can look back over the 6 almost. What are the sort of big changes that you've seen, particularly looking at? Let's look a little bit at the macro picture first of all, macro and economic picture.
Well, maybe beginning at the occupier side. What we've certainly seen is rents have continued to rise. And this is despite the fact, of course, there's been a few economic ghosts on the horizon. But so far, rents do continue to rise in the bigger markets, in good locations for good assets. I think the thing that perhaps has been the biggest surprise is at the end of last year, everybody was anticipating that interest rates were going to go up. And what they did was, of course, exactly the opposite. And that has an effect of driving increasing amount of capital into real estate compared with bonds. It looks like extremely good value, even at current record levels of yield. And I think that probably has been the biggest change and perhaps the most unexpected change there's been over the last 6 to 9 months.
Maureen, in terms of you're looking after a lot of Swiss capital especially, how is that seeing? Has there been a change in terms of how capital looking at real estate is viewing the market at the moment, the capital that you're working with?
Yeah, I think the change that I've seen is it is moving more towards being more selective in the market and actually working with the real estate much more and investing into the right location rather than just buying dry. So the income growth is kind of one of the things everyone is looking at, either through active management of the assets or seeing a rental growth in the right location on a long-term basis. So I think the sustainability of the income over not just 2 or 3 years, but really over 10 years or plus, for the Swiss Life capital is quite important. So they are, they've been investing over 130 years in real estate. For them, long term, it's the key.
And do you see any of a switch from the sort of bond type incomes into real estate? Do you see any of that allocation beginning to shift?
I can't really answer that if it's beginning to shift. I think, again, it's with the real estate, if you've got a team on the ground who is active and can work with the real estate, is it just the growth that you can gain? It's bigger, basically. You can get more for your return. I mean, you get more returns.
Sure. And Carsten, in terms of you're obviously sitting here looking at the capital as it's coming into particularly Germany, but also plainly Linklaters has got offices, very big offices in London, offices elsewhere. I suppose, how are you seeing that comparison that Thomas picked up a little bit in terms of how Germany is being seen versus France versus the UK particularly? UK at the moment is a slightly more tricky question, but...
No, absolutely right. I mean, I usually compare these charts with our own internal numbers, and they usually match. And I've done that over the last 10 years, and they do. So yes, we follow the market a bit because we get instructed once deals are made. So as you might know, that like January to April are a bit slower for us because you're in the pitching phase, and then we started, the instructions start to come in May, June, and if I feel this picking up, I know exactly where the market is, and then I see that in the numbers some months later. So it has been a slow start into this year, then it picked up massively, and like over August, it kind of is, I think, on record levels. That's at least my feeling for Germany. And I think there's good reasons for that, because the London market is just down. It fell off the cliff, basically, in, I must say, March, April, whatever. And you can see that in terms of utilization internally as well. Whilst the last year was really good still. At one point in the beginning of the year, sentiment changed, and London just fell off the cliff. And spoke to colleagues, they did a detailed research into the market, and there's 7 transactions with a volume of more than 100 million pounds in the local market now, and that's nothing for London. So 7 times 100 million transactions. We have more than that in Munich alone. It is really bad, and that drives money into the other locations. Same as for Paris, it's good. Spain is good. Even Milan is picking up significantly, and other places. The Nordics are very good. So it's really, I think there is this capital flow which seems not to stop. Then there's this interest rate which is at minus, and they might lower that to minus whatever. So it goes down and down and down, and no one expected that to come, but it seems to be there for the next foreseeable future. No one is going to change it because the southern European states can't afford it. So it's probably there for the next 5 years or even longer. At the same time, there is pension funds and global money chasing products, so that will stay. And now one big investment market is gone, at least for some time. That obviously drives the money into the German market. And with all the bad and good results that you see, and many of them are bad because the behavior that I see now in bidding processes, and yes, I'm on the sell side and on the buy side, depends on the transaction, but the behavior itself is getting worse. So that's not a very good sign, and maybe a point for all of us. If you're on the sales side, don't overdo it, don't overstretch it. You will always meet twice in life, and there might be worse times out there.
Claus, that idea then, I mean, picked up from everybody there that it's lower for longer in terms of interest rates. Yep. Does that change your strategy? So have you had to adjust your strategy over the past 6 months to accommodate that change?
Picking up on what David said earlier, yeah? I think we were on the same page end of last year. Everyone was actually expecting interest rates to moderately rise again. Thinking that we reached the trough, yeah, but apparently we didn't, yeah. And it was, lower for longer for the last 5 years. Now it looks like longer forever, yeah? Lower forever, which will not happen. But it's certainly clear, as Carsten also said, it will stay here for the foreseeable future. So we have to deal with it. Means, and we're seeing it also in the behavior that you just mentioned. Real estate is still, and probably even more attractive now, is still an attractive asset class. Money is allocated into that sector, and we have to deal with it. We have to deal with it on the investments that we still want to make, and we still think it's a viable asset class to go into, particularly compared to other asset classes outside real estate. And we have the assets to manage that we have under management, obviously. Yeah? On that front, it's good, although Thomas pointed out, it's getting a bit less bright on the occupier side with the overall economy cooling down. But again, that's something that you have to deal with. Real estate, by definition, is an actively to be managed asset class, and that's what we're used to. So we need to be careful in the stock picking, but still then, we have to be understanding that if we want to increase our allocations, if we want to invest the capital for our investors wisely, we need to be selective but also competitive. So being in that sort of tension space, that's the challenge that we have, and that's our job.
David, just picking up, it was interesting as well that in a lot of the discussions we've had, certainly if you went back 2 years, there was about 12 months, 18 months where political risk and general risks had been a major part of the discussion, in the same way that financing used to be a major part of the discussion, and then everybody stopped talking about financing because financing was there. Are people now underwriting risks? I mean, so for example, we've gone through Trump and Korea, we're still going through Brexit. I won't ask you that as a Scot living in Munich, what you think of the English mess of Brexit, but how do you manage those sorts of risks? Because obviously now we've also then got Iran, Saudi Arabia, oil, different things happening. Are some of them things that you have to take as an investor more seriously than others? How do you view those risks, and I suppose how do you try to mitigate them?
I think there's some risks which are obviously just generally there, and we can't do anything about them being there. So, I mean, the biggest risk, of course, that something happens in the Middle East potentially, or that a trade war has a very negative effect on Europe. Those are probably the two number ones. There's a lot of micro-political risks which one could discuss as well, but for example, relating to Berlin at the moment. But to stay at that macro level, we're obviously aware that that kind of effect on tenant and demand. And it's something that we're also going to look at underwriting what's going to happen if tenant demand is weaker. We'll look at a fund level and see what actually effect that will have on what we're doing. We do already see effects of it that we didn't expect. There isn't a trade war really with Europe at the moment, but the trade war in China is already having an effect on Germany. And those things, of course, are combined with other factors, but primarily what we're looking at is tenant demand. We don't think for long leased buildings in this low yield environment there's going to be a big change in pricing unless they just keep going up in value, which is possible. But from the perspective of leasing, asset management strategies, when we're going to do things, we're going to run numbers and look at what's happening on different levels, what the risks are going to be within specific assets and the effect those are going to have on a portfolio. You can't really mitigate for something that's a trade war. You can just bear that in mind in your portfolio structure, how you structure it, and when you take your risks to make sure that you're aware of what those risks are and you take them at the time where you think that's going to be appropriate.
Maureen, one of the other topics that's been coming up quite a lot is sort of particularly ESG, sustainability, and the drive from capital to be able to look far more at that sustainability, carbon neutral, those kinds of investments in terms of the types of capital. Is that something that you're seeing, a demand for more sustainability, more ESG in the capital that's coming into your funds?
Yeah, I think from all sides, I have to say this is becoming much more important, and you just need to tick the box, whatever you like. I mean, if you like it or not, it just needs to be a tick in your box in order to get capital in order to get attention. There is just no excuse not to do that. And also on that basis, yes, you can't avoid any, to take into account any crisis, as David just explained, but also I think what we're doing much more is working much more together with the research teams in order to identify, demographics developments in specific cities and locations. We are much more open to alternatives, but being really specific on why we're doing certain things rather than just going and buying an office building. So I think this is becoming more the norm to really follow what's going to happen in the next 10, 20, 30 years. Is there an opportunity for us to go in early? Also, we're holding back on retail, for example, today, just because we kind of don't really understand where this is heading to. So, and I'm happy to explain to investors, at the moment, retail is just not something we would do unless it's very specific, in specific cities, high street, or something like that. But I think as an investor, it's very important to really identify your strengths and weaknesses and to just have a strategy of what you're doing and being able to explain it to investors and follow that strategy as well.
And does that mean that you're then looking more at the sort of residential space, some of those kinds of ones in terms of that longer term horizon? Yeah,
and I think it also depends on where you work, right? Because, I mean, Swiss Life has a good team doing residential. In Germany, for example, Scorpio Serreo. So, of course, there's an opportunity for us to work with them together. They know what they're doing and take advantage of that. Not everyone can just turn up and do residential wherever. I think there needs to be, a special team that can actually do it, because as we all know, for example, residential in every single country in Europe is still very different.
Sure. We'll come to the sectors in a minute. I just wanted to pick up one thing on the capital for either Carsten or Claus. In terms of the German market, are you seeing any changes in terms of the type of capital, whether that's private equity worth versus private wealth? Are you beginning to see different types of capital at the moment?
If I may start with probably the domestic capital, and speaking mainly about pension funds, who all have topped up their real estate allocation substantially over the last couple of years. Many of them are now at the higher end of their either target allocation or sometimes also regulatory possible allocation, so they're bumping against that one. And that's why when you speak to them, and 3 years ago it was like, yes, we want to invest another couple of $100 million into that sector. It's now we're sort of fully allocated, and thanks a lot. But if you have something interesting, please talk to me. Yeah. So they're probably becoming more selective, which makes sense. On the other hand, compared to the other asset classes, there's still a lot of room and probably also pressure to invest into real estate, because we have the spread that is still positive, although the yields are coming down, as we've just seen. It's still, we have that 200-300 basis point spread over government bonds, for example, and now actually also starting with corporate bonds coming down and becoming negative. Yeah? So there is still a high demand, but I would say it's probably become a bit more selective.
I think, it has changed a bit, so it's a bit more international capital in the market than in previous years. It is still mainly, I would say, Western European, US brands that are investing, or the big German players. And I think that comes back to the market condition, basically, which is a seller's market. So if you want transaction security on your deals, you basically, and you're in a bidding process, and you have like 10 players, or we had like in a big bidding in Frankfurt like 50 plus NDAs, which everybody of you probably signed one of them. And then you're on the other side of the table, and then you think, okay, what am I going to do? I have to report back to my senior management that we've done that deal by that day. And then you go for the players that you know. So in terms of the interest, I think there is a strong international, and also from Asia, there's a lot of capital coming from Asia, and there's a strong interest. But the vast majority of the transactions are being made by players that we already know. It is changing, and there is players that, especially Korean players, that are making their mark in the market, and they're getting traction and track record. And I think you need a track record, and it's difficult to get one. That's what you experience once you start investing in the US or whatever. You have to kind of pay more for the first deals, and then you get traction. But this is the market how it is now. But basically interest from all over the world.
Okay, good. And that's interesting, David. Recently, I think it was last week, Japanese capital buying student housing in Poland, for example. Hadn't seen that before. Are you seeing sort of increasingly wide groups of capital beginning to look across Europe? And how do you see Germany within that?
Yes, we do. Looking at our investor base and who's actually transacting, yes, it's vast majority European. It will remain that way, because you've no currency risk here. That's a prime reason for Europeans to invest in Europe, and a prime reason not to invest outside the Eurozone for many investors, because the currency risk can just be expensive to manage. But what we have seen is a lot more interest, particularly from Japan. We have numerous Japanese investors, for example. They are long-term investors. They're very different investors who have been here in the past, who've just been here for the short term, had a look, done a deal, gone away, usually at the peak of the market, as those of us that are a bit older may remember. If the Japanese come, the game's finished. But I don't think that's the case this time. It's a completely different philosophy they are taking when they're investing. Something that's perhaps worth bearing in mind is that our interest rates are now lower than Japanese interest rates, which is and substantially lower. Which is almost a shock when you look at that and compare with the history that we've come from and what people actually were considering Japan's story was. Maybe we are similar to Japan, and we know now Japan's now been low for 20 years. So maybe that's in front of us, and we have similar demographics, and we're also similar exporting economy. So there's some similarities when you're doing that you can also hear when you're talking to Japanese investors. Some Korean investors are beginning to move towards being more, shall we say, institutional rather than acting as traditional closed-ended funds. That's beginning to happen, but Korean investors, I think, still very much remain in the single asset, long-leased syndicate syndrome. That's where most of them are. We certainly, from further afield, also from Australia, we've had investors for a long time. There's still interest from there. The exception would be the US investors, who are really still primarily interested in high returns and higher risks. And for those returns in Europe, they're not really very often seeing it. As far as they're concerned, Europe isn't really worthwhile. Why go abroad unless you're going to get more? A few years ago, about 2 or 3 years ago, there was a lot of discussion Americans are going to invest more in Europe because they're diversifying. Diversification doesn't seem to be something that they're really interested in. They're much more interested in return.
And is it practical for them when they're looking at the German market to find those returns, if you're looking for that sort of, higher return profile?
It depends on your returns at home. People are comparing it with their returns at home, and the returns everywhere in the world are lower than they were. In the US, they still remain surprisingly, perhaps, buoyant, perhaps because they've got higher interest rates at the moment still. And that means that their yields are higher, so they're going to have a higher cash return than they're getting elsewhere. But when you look at investors in most other places in the world, everywhere real estate's got more expensive. It's not just a European thing, and people are comparing it with their returns at home. And most other investors are also interested in diversification. That becomes important for investors.
This question has come in, which is, in the last couple of months, a lot of portfolios haven't traded in the first instance or take much longer than anticipated. What do you think is the reason for this? Is it slow lawyers, Carsten?
I think some of the plans are a bit overambitious, and in terms of timing, they are certainly. And not because we are slow, but because some things just don't work, and it's good that they don't work, because some price expectations were too high, and sometimes they mixed portfolios with product that really no one wanted to buy, and people are still doing their due diligence carefully, and they take their time for it. And I think that is the major difference from the scenes that we experienced in 6 and 7. And yes, there's a full generation of now almost senior people in the market that have never experienced a bad market, so that's a bit of danger on the long run, that we think it can always go up, but it can go down as well. But that's the difference for time being. People or investors invest into good product in good locations, and they carefully calculate what they're doing. Yes, and they know that they're paying a price which might be too high, but this is due to, you need to invest. And if you have stopped investing like 5 years ago, you made everything wrong. So you need to keep on investing whether you want or not, and people know that it is expensive. But okay, interest rates are low and you need to put the capital somewhere. But except from that, all fundamentals are carefully done, and that's probably what stopped some of the transactions.
And probably just to add to that, my observation is that if you look at, there's still strong interest, but if you look at then the top, say, 3 bidders or so, of course, by definition, they're paying the highest price or bidding the highest price, but sometimes the seller realizes and takes a look at the quality of the bidders, and some of that money may be, very opportunistic, to put it that way. Yeah? So if you want to also have the deal certainty, the quality of the bidder, and making sure that this transaction actually happens on time, and that you have a buyer that you also can discuss sometimes difficult topics with, they sometimes realize, okay, it's probably, we have that set of highest bidders, but we probably need to rethink and probably give up a bit on the price expectations for the benefit of actually making a trade and still making a very good trade.
And honestly, I've seen strange things on both sides. Buyers who were actually brokers, so they had no capital whatsoever and no investor, but they were supposed to buy it, which is far from being nice. And if you try it, you ruin your reputation forever. But still, people try it. So that's this. And on the other side, that people are not sticking to the agreed process, that they're changing the rules, once the transaction is ongoing, which isn't, it's exactly what I said in the first statement. These things are not nice, and not only not nice, they ruin reputation of the market, and that's a bit what people outside the real estate world think of the real estate world, and we should be very careful with these things because we want to attract more and more capital, and we can do so by behaving in a professional way, and then that's, I mean really serious, and that's the same for ESG. There's still people laughing in the industry about it, and that's ridiculous because it's a given, it's paramount, it's the way how we act and how we have to go forward if we want to be attractive for the large institutional capital, and I suppose we all want to.
Carsten was saying earlier, I think there are perhaps investors, and I think that's right, who are investing because they think they have to invest. I think it's important, however, to have the flexibility to not to have to be in that position. That your business plan, your asset management plan has to fit the asset you're doing, and of course you're going to be paying a record price because it's just that's where we are in the world. But if you are investing into a sector, and I think that's why it's important to be able to invest into different things, not just one very specific strategy. If you, for example, don't want to buy a building in Berlin, to take perhaps the classic example, because we were talking about Berlin earlier, because you have to take on some massive latent CGT tax liability, which you're not comfortable you'll be able to pass on to another party or whatever, then you don't have to do that. So if you have a flexibility where you can say, but actually I'd rather do a deal in Paris where I'm doing some refurbishment in 5 years' time, that may well be a better strategy. So you don't have to follow everything to, so to speak, the bitter end, where it gets to the point where you go, I hope this goes well. Yes, you always hope it goes well, and there's always some risk in what you're doing. But to have the flexibility of not to be to the point of say, I have to invest. At that point, you're only just going to damage your future returns, you'll damage your reputation with your investors, and your business long term will not prosper. So what you're looking to do is move around and be flexible enough and be good enough at what you're doing that you can realize the plans that you're actually trying to create. That's the fundamental part. And sometimes also just simply to be able to say, no, we love the asset, but sorry, at that price, we just can't go there. Yeah. Really focus on the things you're really going to do.
Okay, good. You wanted to pick that up?
Yeah, just very quick. And I think we all know we're in a seller's market, so a lot of sellers are just dumping trash on the market, hoping no one will see, and then it takes just forever, and it just doesn't work. But I think that's why a lot of transactions just takes longer than usual. And they're getting more complex as well. So the last transaction we've done, it's just, share deal, very complex. It takes time. So it's just not very simple anymore.
No. And I just want to pick up for your investors in your fund, is the attraction of Germany the sort of safe haven status, or the fact that you've got different cities, as was noted in the presentation, the real difference between Germany and London and Paris, and interesting that hasn't changed over the last 10 years. What's driving that? The attractiveness, I suppose, of Germany for your...
Yeah, I think, it is a very, it's this stable income, and all the economics just, they're just stable, and so everyone loves Germany. It's just a very difficult market to actually get good quality at a good price currently. So the sourcing is very important. The asset management is very important, but nevertheless, it's not just Germany. So they want to see diversification across Europe, across asset class. So yes, Germany, everyone is very keen, but you only have a few cities, actually they are very at the top of the list of investors. So they don't, when they say Germany, they normally just mean those top 6-7 cities. And that's in a very cool location. So it is very difficult to actually buy at the right price currently in those locations.
And is lack of product going to be a bit of a barrier going forward? Do you see that? I mean, at the moment you were saying you've got more deals in a way than you've seen for a long time, which suggests there's not a lack of product. But what's your sense of that?
There certainly is. I mean, because for every product you see like multiple of bidders. So there is a lack of product, and numbers in total numbers could be much higher if there would be more product. There is a pipeline coming, but it will take some time in terms of development. So as you all know, I mean, there's forward deals is the flavor of the month. So we are transacting on deals that are going to be completed in the mid-20s now, which is astonishing as well. So yes, there is a lack of product. We can't do anything about it. So what I would I'm a bit more skeptical with the sort of product. So I think, or my feeling is that we as a real estate industry we don't see the possible danger that comes in the future. As the German car industry 5 years ago, they were trading at record levels, and they were selling whatever car they could build. So and this is what we're doing now as well. And sometimes the quality of the product is just not as good as it should be in terms of the quality itself, but also, I mean, look at what we are doing. Some of these are just boxes, and I don't know who designed them or who the architect was. And that's on the long run, I think, can cause a problem, because then you are not able to attract tenants in more difficult times. And if you look at the developments in cities like Hamburg, Überseequartier, I think that is more solid going forward than many of the things that we've seen, for example, in Munich, because they're a bit boring. Now Werksviertel is getting better, because people are not hungry enough anymore to kind of build something which people really like. And that's going forward very important. And the second thing is, we'll come to it probably in a minute, is that we as an industry we have to develop a certain sense for services. So I mean, it's like WeWork showing us how to fit out spaces. That should be the other way around, to be very honest. And I think that's something where or if you talk to kind of developers and you say, okay, but how is the internet and how is mobile? And I say, we don't care. How can you not care about the quality of the internet and the mobile in your buildings? So I think that's the topics that are very, very important for the future.
There was a quick question here on rents, which I just wanted to pick up. Germany is still seen, certainly internationally anyway, as cheap in terms of rents. Do you agree? And how do you include that in your investment strategy?
I think a very interesting statistic is the GDP per person in Oberbayern here compared with the Ile-de-France in Paris. It's exactly the same. Interestingly enough, exactly the same number. So assuming, of course, Paris is a capital city function, which gives it a different role. So you can't compare them completely, and Paris is a bigger city. Both have very strict planning conditions. Both have, in parts at least, very good public transport. But on the basis of GDP per person generated, you could argue that the rents here could rise very significantly over time. The main determinant for rents is probably supply, and we can see different cities have got different perspectives on this. I mean, to just take another comparison in terms of in the other direction, if you look at Warsaw, the net take-up in Warsaw the last 2 years was 400,000 square meters. It's the same as Paris net take-up. Warsaw, full of international companies, probably to me the most changed city in Europe in the last 5 years, positively, I would also say. But rents aren't really rising. You're buying for above 5% yields because simply there's a supply. Yeah? So you've got economics going on in Paris, you've got it on in Munich, you've got it going on there. Paris and Munich, however, have much more restricted supply pipelines. Munich's potentially even more restricted than Paris, and companies could potentially afford to pay more rent if that's the GDP per person being generated. So there are good arguments to say that rents could be very much higher than they are today.
Okay, good. And in terms of just looking at the opportunities with the sectors, just drill down a little bit more, Maureen. So you already mentioned that you were out in terms of retail at the moment. And you're looking at some of the alternatives. What are you looking for specifically there? Are you looking at things like senior housing? Are you looking at things like student housing, micro-living? What aspects do you see the opportunities in?
So we're actually quite open to any of those that you just mentioned, depending on where it is and what the opportunity is. So we're working with the European research team from Swiss Life just to identify where we see the opportunities really over the next 10 years. So we're not talking about the next 5 years, we're really, really long term. And where we can actually, in which markets we can go, where we don't face so much competition around us. I know that's difficult, but we're willing to go into Italy or even Poland, student housing or senior housing, just slightly different to what everyone else is doing. That's what we're trying to do. I mean, Germany, we all know, huge potential, Austria as well, many, but, it's difficult to kind of get in today at the right price.
Okay, and Claus, from your point of view, you're obviously sitting here looking at the German market. What are you seeing in terms of particularly the sectors? Are you also down on retail? Are you focused on offices?
It's probably both. First of all, the German picture and then the pan-European picture. On both sides, we traditionally have been a very strong office investor, and we still like office a lot, because we also see the potential still in office, with vacancy rates in the major German cities coming or being below 2%. And even if the economy cools down, what David just said, rents are cheap in an international context. And of course, you have to assume some rental growth in your underwriting. Otherwise, your business case simply wouldn't work and you won't be competitive. It's just a question in terms of risk scenarios, how high will the rents rise? And so office will definitely remain an important sector for us in our portfolios. Also down on retail, or let's put it that way, very selective on retail. Logistics, not just flavor of the month, probably flavor of the last 5 years, but we have bespoke logistics funds that we want to allocate more of into the market, and other diversified funds that also can do logistics. So also from our side, huge demand. And then more the specialist sectors. For example, in France, we're one of the largest healthcare investors. And that's definitely an expertise we want to use more and increasingly do also outside France and across Europe, and Germany, again, being probably the next big stop in that respect from our perspective, because it's the largest market also in that respect when it comes to volumes. And one thing that I actually like about our company is going to very niche things, like in France, we run a camping ground fund as an institutional product, by the way. So far, it's France only for French investors only. It's got a size of around 150 million, more to come. But in France, there are camping grounds that are as large as 20 million. So you can actually select a portfolio of that institutional type quality, because you have operators like you have in the hotel business that run camping grounds very professionally. So it's what I try to say here is, you have to be very open-minded. You have to be open-minded also when it comes to looking forward, when it comes to retail. Everyone's down on retail because, the traditional retail doesn't work anymore, or not in the same format. You have to be a bit more creative. Things that Carsten said, like, you have to think about also nice things, because if you have a space in a city location that people like and go to, you will find someone who's prepared to pay some rent for that space and do something there, be it working, running his business there, doing a restaurant there, living there. So it's, I think, more of the quality also in terms of mitigating factors that we were speaking earlier. You have to more than ever think about quality, whatever that means, or usability of the space that you're investing into.
Okay, good. There's a question that may plausibly take up the remaining 8 minutes that we have, but I'll do it nonetheless, because you've put which is, does the real estate market expect a hard Brexit, and can you see any market movements for Frankfurt? So there's two questions, one slightly more complex than the other one. What's your view? Is Frankfurt really going to benefit? Is it already benefiting, or is it just all talk?
I think it's benefiting already. Not massively, but it's benefiting already. We can certainly see there's more banks taking space in Frankfurt, and we can see in the kind of space that they want to have that rents are rising. Whether it's going to be dramatic, I think, is another question. And where it long-term leads, where's the job growth going to be in the future? Is it going to be in London, or is it going to be in Frankfurt? That's maybe the more determining factor. It's not going to be, I don't think, thousands of people getting on a plane and going to Frankfurt and moving into a new office.
I mean, what is offsetting probably that effect on Frankfurt a bit is the difficulties that the German banks are in. So German banks laying off people. On the other hand, international banks increasing their presence in Frankfurt. So in that respect, the effect is probably not as big as it could have been.
That's right.
But it's more due to German banks rather than the Brexit effect.
Yeah, it tends to be smaller, good quality space where the rents are rising and where these banks are wanting representative space rather than sort of 20,000 square meters of people sitting in the back office. That seems pretty unlikely that'll go to Frankfurt.
Yeah. And in terms of Brexit, does any...
I would lose a big bottle against Lord Hague. I have a bet ongoing with him that there's no Brexit, but he might win it. I was always very positive because I couldn't believe that this was going to happen. I'm a bit more negative than I was. London will certainly survive and recover, and it's a great city. I love the city, so it will do. It's super unnecessary, but there have been things, especially in Germany, that have been unnecessary as well, and we've done them. So I don't know. I mean, it can happen. London will recover. Unfortunately, the regions that are voted in favor of Brexit will suffer the most. And then we will take it from there. But Paris and Germany will certainly profit if it happens, which I don't hope.
Yeah. And I think, I mean, unfortunately, it's looking more and more likely that it will be a hard Brexit, because I can't see why there should be another extension. And Mr. Johnson behaving as he is at the moment, I think he's just probably forcing a hard Brexit from the other side. Yeah. Well, anyway, but again, like Carsten said, London will survive. It's just a shame. It's a pity, and it is what it is.
I'm not sure that say Paris and Frankfurt and whatever is all going to do better because of a hard Brexit. Maybe, but probably not. I think everybody will suffer in the case of a hard Brexit. It will just be a chaos, and we'll just have to live with that. Whether it comes, however, I don't think any of us really know.
But on a long-term basis, it's not going to be a massive change. I mean, in a few years' time, London will be where it was before. Yeah, I think.
I think so too.
Yeah, I'm not sure about that. I think for London that's correct. I think for the rest of the UK it's
a drama.
Much more questionable.
I agree. And look at, I mean, if you're in London, look at real estate prices in housing. Their price level is lower than Munich. So if you want to make a bargain, do it now. It's really cheap. It's cheap, and there's a lot of product on the market. And if you see that, you feel how skeptical people are, and that people are selling their homes. It's really dramatic.
So that's for anyone thinking about buying a house in the UK.
Depends on your like-for-like comparison.
Yeah, I wasn't expecting to introduce that as a discussion point, but that's good.
I always wanted to have one. I could never afford it. So.
Yes, that's right. It depends if you like double glazing or not. That's right.
Unaffordable.
I'd maybe wait a couple of weeks more just to see. You may finally go down a bit more. Good. There was a question just here. I haven't got a microphone. I don't know why I've stood up, but I have. Anyway.
Yeah, no problem. Just wanted to ask an offline question.
Yeah.
In terms of the changed interest rate policy and the capital we expect targeting the real estate market, what do you expect in terms of pricing for the next 12 months? And related to this, what about your return expectations for the strategies in place?
We think yields are going to fall.
Yields are going to fall. Okay.
Mm-hmm. For good assets, yields will fall. And they don't need to fall very much now, because when you look at the yield compared to the German factor, a little bit of yield is an awful lot of factor now. It's got to the point now where pricing is hyper sensitive to the part of the table when you were at college you thought you would never look at. So it's got to that point where factor and yield. Yeah. Yield just needs to move by 10 basis points now, and it makes a huge difference to the multiplier. Yeah. So that will help generate more return over the next 12 months. Yields will move in, and rents are continuing to rise because there's so little supply.
I will probably add, when it comes to selecting the product, it will differentiate probably a bit more. So for the best quality, what you just described, I think is certainly the case. But on the other hand, like we addressed also earlier, that doesn't mean for every deal and for every asset. Yeah? No. Because when there's weaker quality, I think people will also get more mindful of risks and risks being not just the pricing, but the overall economy, and we get more sort of bad news in over the next quarters, I think people will really be a bit more careful, still saying, okay, I got to do something with my money, and if I want to focus probably on the best, whatever that means. But I think so that means, that statement probably will not go for real estate per se, but, be a bit more differentiated.
Long leases will become more important, and tenant strength, which everybody's been completely ignoring, frankly, for the last 5 years, I think, will suddenly become important when we see that first tenants go bust. The only place people are looking at that currently is retail, where people are looking at tenant strength. And the big question, of course, is where retail is in 12 months' time. And in some cases, once transactions really start to happen, maybe in some instances it might be reasonable value compared to other things.
Okay, good. Any other questions or any other comments that anybody wants to make? There's one here which tends to be agreeing with you, Carsten, which is, despite Brexit, why not invest in London with a nice discount? So
it's the currency risk.
Yes.
It can drop by another 20% easily. But if the hard Brexit really happens, which I don't hope, and currency goes down by 20, then buy. Strong buy. The islands and the holiday houses that you could have bought in Greece 10 years ago tripled in price, because there is no fundamental reason for London to be cheaper than Munich. It's just not there. Yeah. Yep. And there's the only, and I said it in an article, the only German city that can ever match London, but over the next 50 years, is Berlin in terms of the size and the shape. It's not there, it will take some time, but all the other places are nice, but far from London. So, buy it.
Okay, good. Last thing, which is to each of you, biggest, this is for everybody, just to sum up really, is what do you think is going to be the biggest sort of trend in capital flows over the next 12 months to when we're back here next time? Let's start with you, Claus.
Probably continuing like it is to a big extent. Yeah. So not expecting any fundamental changes. So we're all trying to fight to find the deals that we would like to do for our portfolios. We'll see what the pricing will do, and we have to be very mindful of that, but also on the other end be competitive. So I think it's more for longer in that respect.
Okay, Carsten.
I think we will see more interesting service-oriented products, not only WeWork, but others also from the tech industry, real tech industry, will drive the market. I don't know where, but they will do. Okay, good. Maureen.
I think we should be watching Asian capital coming in as a kind of JV partner into Europe rather than just with funds. And also watching the private equity players, how they get to their returns. That would be interesting to see.
Okay, good. David.
I think the biggest change might not be so much from the equity side, which I think will remain similar, and I agree very much with the comment about Asian investors. There's a lot happening there. But I think we may see people using higher levels of debt, because debt is now so unbelievably cheap that it is at this level of cap rates, people may choose in some cases to use higher debt than they've been using in the past, also within core strategies.
Okay, so we may see debt going up.
We may see debt, I don't think dramatically, but we may see an increase in the level of debt that people are using because the debt is so unbelievably cheap.
Okay.